Hello everyone, welcome back. I got a lot of really good ones for you today. So, markets are still digesting the Fed rate hike. If you go back 6 months, every Fed meeting they've hiked, markets fell going into the Fed meeting, and then after the hike would shoot back up and then roll back over. All those rips higher would just get faded. So every Fed meeting this year has gone down like a rotten burrito, and it's looking like this most recent meeting is no exception. I understand that the Fed has to become more hawkish over the summer in order to get a vote of confidence that they're doing something about inflation, and they're trying to catch up with raising their prime rate. So I understand why traders thought last week we would see 50 basis point moves, and then the Fed actually moved to 75 basis points, especially with that really hot CPI print we got on Friday. So I understand how those expectations for more hawkishness got elevated, and it may continue that way for the next couple hikes. Especially, this is what the Fed is kind of calling their front loading. Some of these more aggressive 75-point hikes, which they said would be really rare going forward. So we'll put that off to the side. I'm looking out past this summer. So if this summer does lead to less trucks, less stuff on the shelves, layoffs, more liquidity events, margin calls, mortgage rates being kind of too high in that danger zone, which starts to really put a lot of downward pressure on home prices. If I see that continuing maybe over the next 60 days or so, especially with peak hawkishness and peak bear feeling. But I mean, like, seriously, the sentiment has gotten so bad. Like, at a table of 10 players in the rigged casino, 10 are bears right now. You almost want to become a bull just on principle, right? Maybe not, but, just saying, just book might say just flip bull to stand on principle, right? But totally maybe not, because the system could continue to buckle. Because they're all bears, and we're kind of going into some sort of Ice 9, Jim Rickard Ice 9 scenario where the system really starts to freeze. So what I see is peak bearishness and hawkishness through the summer. Maybe demand falls over summer, like the economy just in the financial system both just get punched in the face a few times. But then the Fed can actually be in a position to take some of these 12 rate hikes we have coming off the table. The Fed is pretty insistent that by 2023 the prime rate will be 4%, but we'll have to see about that, because I don't know that the markets can handle it. And even though this last 6 months the Fed has moved more or less in line with policy that protects the dollar consumer and gets inflation under control, Powell still reiterated yesterday he will protect. He's not trying to induce a recession. I read that as he'll protect the B system, especially because he followed that up with reiterating that his policies affect the financial system, which ultimately affects the economy. So I see us getting through a hawkish summer. Then I see more dovishness, actually. Some of these rate hikes come off the table. Then inflation coming back, because the Fed is forced to pick control inflation or save the B system. The beast is getting pretty beat up right now, and I don't know how much longer that could continue before the markets cry uncle and the Fed has to come back. We especially could see that happen, like maybe a few rate hikes get taken off the table and fall. And look, I understand this is super contrarian, because no one's even talking about taking rate hikes off the table or cutting interest rates right now. But if the Fed is ultimately forced to pick between the dollar and the B system, especially now that the B system has been beaten up this bad, the Fed could flip its priority back to the B system, take rate hikes off the table, stoke some more inflation, hurt the dollar some more, and send risk assets to all-time highs. I mean, risk assets could even start crashing up if the economy were to slow down over the next few months so badly that the Fed has to even cut rates. I don't see the Fed cutting at least for like 6 months, because if they did that, the bottom would fall out of the dollar like instantly, right? The dollar would implode. And then risk assets would hyperinflate, but it wouldn't be stable. It wouldn't be pretty. It would really suck actually for everybody. Even the people that are like long the risk assets that are hyperinflating, nobody would be having a good time with that. So I don't necessarily see the Fed cutting if they absolutely have to, but we also have to look at the rest of the global economy, and it is slowing down. The ECB, they're already, without expanding their balance sheet, trying to get creative and using debt to kind of prop up their debt market. And so they're already moving into emergency type policies, the ECB and Eurozone. They're already moving into those emergency type policies because they can't handle these tighter monetary conditions. And so if you think the dollar is just going to continue to tighten this much while other countries' central banks are falling behind and maybe even easing in some weird creative way, I don't expect that divergence to widen. I would expect the Fed actually to, if anything, blame the Eurozone and ECB for needing to ease so that the Fed could keep their policy steady or even take some rate hikes off the table. Basically, the Fed might be able to act more dovish in a few months, not because inflation has gotten any better, but because all the other countries are slowing down and starting to ease, and you can't have the dollar moving up relative to all these other currencies like that much. You can't let that spread widen, I guess, if that makes sense. So I see us being hawkish through summer. I wouldn't be surprised to see a 75 basis point hike for July as well. But then, especially if inflation comes down and things really keep buckling and going Jim Rickard Ice 9 on us, I expect the Fed to take interest rate hikes for the future off the table. And I expect them to lower their projections for what the prime rate will be. And that will move risk assets higher. I'm just trying to think ahead, right? The Fed, on the flip side of that, the Fed could keep tightening and just not care and watch the ECB try to loosen and try to survive and just not care and force the ECB to tighten further and just keep, tightening things up until you see mass liquidations, mass margin calls, mass defaults, like honest defaults, like chips and dollars just disappearing, just a very deflationary walk away from the players, walk away from the table type deflation. I don't see it though. I mean, I could see that situation, and if you believe that's the case, pull out your dollar suspenders and hang out with King Dollar all day long. Like, I totally get the bullish case for the dollar, especially right now, and especially how much more scarce those dollars and cash on hand is going to become if we start to really see massive deleveraging and massive deflation and just poker tables left and right in the rigged casino just disappearing and poofing like that. That would be massive deflation, and that's what the Fed's signing us up for. And so I'm wondering when they flip on that. And you're like, well, they can't flip on that because it would create even more inflation. Well, they got to pick. Go back to trashing the dollar, go back to running up your gas and groceries and save the B system, or continue to watch the B system come down by 3 to 5% in the equity markets a day in a otherwise rather futile attempt to get inflation under control anyway. Because that's the other thing. The Fed's trying to raise interest rates like 75 basis points to get inflation under control. Like, that's so hawkish. But like, step back. There's still doves, baby doves, always have been, always will be type players. Meaning, for all this hawkish rhetoric, they sure are like 8 or 9 full percentage points in the prime rate behind breaking the back of inflation. And if you really tell me that, well, they're dead set on doing that and continuing to jack up rates, okay, well, this is what you get, and I'm wondering when the Fed realizes that they can't let the system keep freezing up. So it's weird because it's like the Fed either turns the dollar into a block of dry ice or turns the dollar into like molten magma, and they're trying to bring stability and strike a compromise there, but they've janked their own game up in such interesting ways that it's almost like they got to pick which way we go. Like, do you want to hold the block of dry ice? In that case, you're a dollar bull. Or do you want to, just keep heating up this molten magma and just completely incinerating the absolute value of the dollar and driving asset prices higher? So I'm under the model that they're going to try to preserve their balance sheet. They say they want to roll it off. Everyone's saying they're going to roll it off, but I don't see the Fed balance sheet going much lower from here without creating even more damage. So at a certain point, I think the Fed is going to kind of hold on to their balance sheet, maybe take some rate hikes off the table, and then if things slow down really badly, and even cut again, but I don't know that we're looking at any rate cuts right now, like I said. But I think ultimately the reason I always default back to cutting rates and yields and those going lower in all my videos overall is I understand that interest rates are at like 5,000-year lows, and people are saying all the time, can't go on forever, can't go on forever, can't go on forever. But in my personal opinion, the overall trend of interest rates and yields going lower, and then maybe even negative in nominal terms in the US, I don't think that trend has been completely broken yet. A lot of people are saying, yeah, it has. Structurally, rates and yields are going to be much higher going forward. Like, that's done. But I'm saying big picture, especially with a slowing global economy and demographic issues, and the Fed existing to want to prioritize the B system at the end of the day, you know, I put all those reasons together, and I'm just seeing a situation where the Fed blows it out and continues to expand their balance sheet into oblivion. They have to borrow more and more into existence just to maintain where we are, never mind additional growth. That's the nature of the beast system in a debt-based monetary system, is that more and more be borrowed into existence in perpetuity just to maintain where you are, never mind additional growth. So if the Fed sticks to that model, I see ultimately this ends in the dollar getting incinerated and risk assets hyperinflating. And I'm not even wanting to say that that's even a good thing, but I don't see Jim Rickards' ICE 9 freeze up of the system continuing much longer before the Fed cries uncle somehow, finds a way to put off these rate hikes somehow, just bites the bullet and just accepts that inflation's going to be high and protects the beast. So that's kind of what I see happening, but I could totally be wrong, right? And we're just passing ideas back and forth. And which, by the way, you know, leave a comment, hit a like, sub, whatever, and you can get involved in kind of the discussion. What do you see happening? Do you see interest rates and yields continuing to rise? Mortgage rates hitting 9.5%, putting housing prices down 40% from here, and the Dow Jones below 25 grand? Or do you see the Fed coming back, taking some of these rate hikes off the table, throwing in the towel on inflation and consumer goods, and just protecting the beast? Like, what do you see going on? I'm curious to hear your thoughts, and that's kind of all I got for you right now. Till next time.